Thomas the Economist, rocking the bomb, common sense, 20 years in finance now, popping off like poppadoms. Today I wanted to look at universal basic income, or UBI, and in particular what impact UBI has on rents, house prices and inequality. The short story is that UBI, as I see it, doesn't have any mechanism to break down this fundamental tendency that the economic system has to accumulate wealth and power in smaller and smaller hands towards the top of the pyramid. And because it doesn't do that, simply adding more money to the system actually accelerates this dynamic. It accelerates the accumulation of wealth and power and accelerates inequality. So I'm going to look at that. I'm going to model quickly the impact on rents and house prices just to get a bit of a feel for the dynamic. And I'm going to look at three channels of disadvantage that I think come with the UBI, unless the UBI has some mechanism built into it to stop this kind of disadvantage accruing, like a broad-based land tax or like a universal basic housing scheme, something like that. But I'm not going to look at that. I just want to have a look at what the dynamic is that perpetuates inequality with the UBI. So I'm going to look at three channels of disadvantage. The first channel is the income channel, second channel is the equity channel, and that's sort of about house prices, and the third channel is the competitiveness of the housing market, so how easy it is for first home buyers to buy their first property. Okay, so let's have a look at our economy. I'm going to assume here there's some renters here in red, there's owner-occupiers in green and investors in blue. I'm going to look at what happens if we give these guys a universal basic income. So if you give the UBI, I'm going to say, let's just pick a round number to make it easy, pick $1,000 a month per couple, so $500 per month per person, which isn't a huge amount in the scheme of what's being trialled with UBI. But let's go with that, $1,000 per couple per month. Now if we give that to renters, some of that is going to go through into their rent. Unless we're assuming that renters are able to hold on to all of that money and the amount of the share of their disposable income that's going to housing decreases, that's quite a big assumption, some of that money is going to feed through into rents. The question though is how much, and we don't know, and the rent's going up to the investors, and we're assuming the couple in red there, rent's off the couple in blue. So there's a question mark about how much that is actually going to be, but we know that it's bound by $0 and $1,000. So at $0, the renting couple holds on to all of the money they get through the UBI, and at $1,000 they lose all of it. All of it feeds into their rent, and that goes through to investors. So the question about where we sit within that range of $0 to $1,000 is really a question of market power, and the balance of market power between renters and between property investors. And in part this swings on the demand-supply balance, so how many renters there are relative to how many investors and investor properties, rental properties on the market. It's that balance, but it's also about institutional factors. And these institutional factors, sort of like the legal arrangements and these sort of things, by and large these tend to favour investors, and that's not necessarily a mark of evil. It's just the reality that finding new tenants for your property is much easier than it is to move out of a house and find a new suitable house and move into that new house. It's just a different beast, and so the system tends to favour the market. The balance of market power naturally tends towards investors, and then on top of that you add the cyclical dynamics of the demand-supply balance. But what I want to do just to start and just to look at, just to sort of isolate the dynamic, is let's assume that all of the money that goes through to renters ends up getting passed on to investors in rents. And what I'm assuming here is it's a very competitive rental market, almost a perfectly competitive rental market. And I think in Australia, and we'll look at where I live in Mullumbimby in the Byron Shire, sort of near Byron Bay, I think we're approaching a market something like that. Like it can be, particularly at certain times of the year, very hard to find a suitable rental property, and you have to pay premium dollar for it. And so in that kind of scenario where it's very competitive and renters are being played off against each other, you can see rents start to increase, and if all renters received a boost in their incomes, then that would just feed through into rental prices. So if we have a look at that here, so our rental couple gets $1,000, that gets passed on to investors, feeds straight through into rent. that goes up $1,000 a month through the competitive market. And so if we have a look at how that balances out, if we're looking at income, in the first round, everyone gets $1,000, renters, owner-occupiers and investors, everyone gets $1,000 per couple per month. But renters end up with nothing in their pocket because it all feeds through to investors through rents. And watching that rents go over there, their $1,000 now becomes $2,000. And I mean, we're simplifying a lot here, but you get the idea. In a competitive rental market, UBI feeds straight through into rents and gets passed from renters to investors. And so this income channel becomes a channel of disadvantage where we're giving no advantage to renters, but we're giving a massive free kick to investors and the owners of rental properties. That's one channel. The second channel is what I'm calling the equity channel. So when we think about with housing, a housing is a home, it is a place to live, but as any financial planner will tell you, it's also your most important asset. And because it's an asset, we can kind of think about the price of housing a bit like in terms of a financial asset class. And in that sense, an asset price, the price of an asset is a function of its asset return. So how much income stream you're getting out of the particular assets. In the context of housing, this is captured by the idea of yield. And so the gross yield, looking at the formula, is annual rents over prices. And that tells you, gives you a feel for how much income stream is coming out of your asset, out of your investment property. And what we find, if we look at yields here, yields in the blue, yields in the orange, yields tend to be very constant and very steady, and they tend to hovering around 4% in Australia since about, pretty consistently since about 2003. Even though the market, in terms of market rents or market prices, is, quite cyclical, yields tend to be quite steady, and that's because yields key off interest rates and other structural factors of the economy. They're not keying off the market. In a sense, we can think about yields as independent of the market to a large degree. And so what I'm going to do then is, if we assume that yields are holding around 4%, which historically over the past 10 years or so has been true, and let's look at a representative house in Australia. So we might say that the house price is $500,000. That's its price, it's what it's worth. It draws in rents, if it's a rental property, of $385 a week, which gives us a price of about $20,000 a year, and that gives us a yield of 4%. So that's, that might be the representative house in Australia. Now what happens if we're in this competitive rental market and the couple gets $1,000 a month, it goes straight through into rents, and so rents increase by $250 a week. So what happens there? Well, that rent becomes $635 a week, our yields jump up to 6.6%. But that wouldn't happen because yields are constant. Yields aren't determined by what's happening with rents, they're determined by structural factors in the economy, and they're going to hold at 4%. So that means that adjustment, if yields come back to 4%, the adjustment must be forced onto house prices. And for yields to hold at 4% while rents have increased to $635 a week means that house prices, the house price here has gone up to $825,000. Now that is a massive increase. That's increased $325,000 or 65%. Now those numbers are pretty amazing, and I had to sort of stop and do a double check when I crunched those numbers, because what we're talking about here is a relatively small UBI. We're only talking $500 per person per month. We are assuming it's a perfectly competitive rental market, but some rental markets are, and over time, all rental markets become perfectly competitive at some point. It seems to happen that way. So it's not a particularly strong assumption. We've got a low UBI, a big-ish assumption on how competitive it is, but even still, that creates a massive increase in house prices, which is obviously a massive win for the people who own property. So we're looking at equity. Well, renters don't have any equity, they don't own a house, so they don't see an increase in their house prices. But for owner-occupiers and investors, they've seen a big increase in their house prices, and happy days. Now this obviously isn't great news for our renters if they're wanting to get into the housing market, because now house prices are suddenly heaps more expensive. But it gets worse. So that brings us to our competitiveness channel. So if we come back here to our equation and looking at what's happened here with house prices. Now, what would happen for a portfolio investor is that they've had a massive increase in equity, and so they're able to refinance whatever mortgage they've got on their property and draw down the equity. This is the sort of classic investor scenario. They draw down the equity and then they can use that to feed into another deposit. So if we're assuming a loan to value ratio of 80%, pretty typical, that $325,000 equity gain gives them the capacity to draw down $260,000 to use whatever they want. In that sense, it's a deposit on a $1.3 million property. So this becomes our third channel of disadvantage, because while our renters have seen no improvement in their competitiveness, they haven't seen any increase in equity, they haven't seen any increase in income. Our owner occupiers have got a massive gain, but our investors, they've got two free kicks, because their income has gone up. We can see that $2,000 there. Their income's gone up, so their serviceability, their capacity to service a loan has gone up. Plus, they've got a massive increase in the equity of their existing properties, which they can then use to feed into another deposit. And in this scenario I'm modeling here, they've pretty much got an entire deposit on a whole other house just given to them. And so if we're worried about home ownership rates, and we should be, this UBI here creates a structure where we're advantaging investors over renters in a massive way, and we're empowering portfolio accumulation of investment properties over first home buyers getting into the market. And so we're creating massive structural inequality. Now you might be saying, well, you know, you set the bar pretty high. You've picked a really competitive market where all of the money that feeds through to renters gets passed on in rent. It wouldn't be that bad in reality, and that might be true. So let's look at a scenario where our renting couple gets $1,000 a month, and only $100 of that gets passed on into rents. And what we're assuming there is that the proportion of their disposable income that they're paying towards rents goes down, because the income has gone up by more than their rents have gone up. And that's, you know, that'd be a great outcome. If those were the actual numbers, I think we'd be calling that a success. But if we look at what happens to our scenario, to our channels of disadvantage, on the income front, we all get $1,000, but the renters lose $100 to rent, and so what they're putting in their pockets only gone up by $900. Owner occupiers, it's gone up by $1,000, but investors, it's gone up by $1,100 because they've had that $100 transfer. So again, investors are still coming out ahead. If we look at the equity, all these numbers are going to change. So we look at rents, that's only 410. If we hold yields constant, that means we're looking at 532,000, or an equity gain of 32,500. That's not as dramatic, but again, if we look at the equity considerations, so they draw down 80% of that, that's $26,000. And that's not a deposit on a $1.3 million property, but it is $26,000. Now, $26,000 in the market, when you're trying to save for a deposit, that's not to be sneezed at. And what we're saying is that while investors get this free kick of $26,000, renters just have to save that. They've got to come up with that money, even though they're getting less income than investors now. And so even at a scenario where you'd say it's actually a really good outcome, you're still disadvantaging renters relative to investors. And so you're still empowering structural inequality in the market, in the housing market. And so really what we're saying with the UBI is that on that spectrum from $0 to $1,000, $0 where renters hang on to all of it, $1,000 where it all gets lost into rent, on that spectrum, the only outcome where renters are not disadvantaged relative to investors is where they hang on to all of it, is at the 0 point. But what we're saying is that every other outcome on that spectrum from 0 to 1,000 creates an advantage for property investors over renters and accelerates and enforces structural inequality in the market. What I think this all means is that the UBI, as we currently talk about it, is fundamentally misdiagnosing the problem. And it's tempting to look at certain segments of society and say, well, they don't have enough money, therefore if they had more money, that would solve that problem. The economy just doesn't work like that. there's no elements within the economy exist in isolation. Everything exists in a relative balance, and you've got to look holistically at the economy before you start tinkering with things. And we saw this with the first homeowners grants. That was an idea that first homeowners were struggling to get into the market, so if we gave them some money, they'd get in. We saw that feed straight through into house prices, and it was homeowners who were selling to the first home buyers that walked away with the money. And so I think we risk making the same mistake with universal basic income. But I do think we need a universal basic income, and because I think we need a system that's going to allow us as a society to transition away from work, simply because technology is going to destroy jobs faster than we can create them. But I think we then need to recognize that for UBI to work, it needs to go hand in hand with some features that structurally adjust the economy and structurally disempower these inequality dynamics. I don't know what that is. I haven't really thought about it. It might be a broad-based land tax. It might be a universal basic housing scheme. It might be a commitment from the government to keep the housing market in a perpetual state of slack, so that we don't, these universal basic income doesn't just feed through into rents. And that might mean, nationalising housing to a degree, nationalising housing construction to make sure there's always enough houses, that we don't have competitive markets. But that's pretty massive too. But whatever it is, I think we need to recognise that the economic system we have has a tendency to concentrate wealth and power towards the top of the pyramid. Simply adding money into the bottom of the pyramid without changing that tendency to concentrate power just accelerates the problem. And I think for advocates of UBI, we need to be looking seriously at that. This has been Thomas the Economist. See you next time.